Good morning, everyone. This is Stuart. Hope you had a great weekend. Want to note at the outset that we'll run over 5 minutes today as we think there's lots of important news to cover. On this week's update, we'll discuss the government shutdown, an economic red flag in the services sector, the latest on AI, and the idea of currency debasement, hence the golden Homer Simpson. To start, the federal government has been shut down since October 1st as Democrats and Republicans failed to agree on terms to fund the government through November 21st. At the heart of the dispute are expiring health care subsidies and cuts to Medicaid. You can probably get better political analysis elsewhere, so we'll stick to markets for our discussion. Right now, investors are looking through this in the expectation that the government will soon reopen. The longer this drags out, though, the more we might see some economic impacts that do filter through to markets, from the lack of key data releases to a potential drop in consumer spending. Just to note that in 2018 and 19, the government shutdown lasted 35 days, which was the longest shutdown on record. We hope that record holds and that the two sides soon resolve their differences. While we wouldn't advise selling assets because of the shutdown, we do want to flag the potential for a prolonged fight in DC to dent risk appetite. On the economic front, we are starting to see deteriorating data after a strong second quarter GDP number. The services sector stalled in September as business activity shrank for the first time since the pandemic. ISM's index of services dropped to 50, a level that indicates stagnation. The figure was weaker than all survey estimates. Additionally, the Business Activity Index, which is akin to ISM's Manufacturing Index, fell more than 5 points into contraction territory for the first time since May of 2020. While not dire, softness in the data does suggest that the 3.8% growth rate from the second quarter will be hard to sustain, and that there are signs of weakness outside booming capital expenditures for artificial intelligence. Speaking of AI CapEx, the spending charts continue going up and to the right. By 2030, over $500 billion in annual capital expenditures is now expected for the main four US hyperscalers, Alphabet, Amazon, Microsoft, and Meta. If anything, this is likely to be on the low end. We've discussed in previous correspondence how the investment profile of these companies is shifting from a capital-light model to a capital-intensive one. Investors over the last decade prized large-cap tech firms for their low marginal costs and high cash flow generation. That model is turning on its head now as these firms have to spend hundreds of billions annually to drive forward compute for AI. We think this will prove economically valuable over the long term, but the margin for any disappointment will shrink as CapEx levels rise to 60% or more of operating cash flows, from just over half that level 5 years ago. Right now, investors are rewarding these huge CapEx plans, but that could turn into punishment if higher spending doesn't translate into higher sales. As we said, we expect these CapEx numbers to continue rising. One reason is that we think compute-intensive video generation features are about to take off. Last week, OpenAI unveiled its Sora 2 video generation model to much fanfare and positive reviews. Sora 2 comes out less than a year from the original Sora 1, and the improvements are remarkable. Users can prompt the model to generate hyper-realistic short clips and insert themselves or their friends, with their consent, into videos. The Sora app is now the #1 on Apple's App Store just after a week. We think AI-generated video, whether from OpenAI, Meta, or Google's Veil model, has the potential for virality. But with great fun comes great risk. We'll show 2 videos that demonstrate this. In the first, Sam Altman steals IP to use in their AI model, and in the second, and most popular post on Sora, he gets apprehended by security at Target for stealing NVIDIA's GPUs.
Man, it's so cool. Everything is free. Okay, I'm taking these.
Oi, Damida, bring those back.
Whoa, gotta go.
Stop, give them back.
Nope, too late.
Hey, come back here.
Free art, baby. Please, I really need this for Sora inference. This video is too good.
Now, it's safe to say that these models will only improve and that the prospects for malevolent usage will only grow. We all need to become more discerning of what's real and what's fake. Briefly, we do want to mention that OpenAI, coming off the heels of a $100 billion investment announcement from NVIDIA 2 weeks ago, today announced a deal with the chip firm AMD to supply OpenAI with 6 gigawatts worth of their chips starting next year. Interestingly, OpenAI will receive warrants for up to 10% of AMD shares as part of this deal. Now, that's a far cry from the NVIDIA deal, where OpenAI essentially is selling their equity to NVIDIA to finance their purchase of NVIDIA's chips. Still, this is a major win for AMD. We do have questions, however, how the potential trillions in capital spending over the next 5 years will get financed. But for now, selling compute power is a fantastic business to be in. Finally, 2 quick notes. We wanted to highlight that Google Gemini's market share in AI model usage has more than doubled over the last 6 months, from 5.5% to 13.7% usage. The rumor is that Gemini will release its next model, Gemini 3, this month. We've been using the Ultra version of Gemini, its most expensive tier, more frequently of late and are impressed by its capabilities. We expect the next model release to take the lead over those from ChatGPT and Anthropic's Claude. The rate of improvement across all the models is incredible, but Google does have inherent data, compute, engineering, and critically cash flow advantages that will be hard to match. Lastly, you may have noticed that gold is up 50% year to date, while Bitcoin is also trending higher. These assets are attracting inflows as investors worry that governments globally are giving up on fiscal restraint and inflation targets in a bid to boost growth. If you'd like to discuss the wisdom of holding these and risks, we'd be happy to talk. Typically, our preference is to own productive assets that generate cash flows from underlying businesses. We just note that most financial assets, especially strong global businesses, stand to benefit from a weaker currency and moderately higher inflation as their revenues, earnings, and cash flows grow in nominal dollars. If you have any questions about today's discussion, please feel free to reach out. Thank you and have a great week.